All right. Good evening, everyone. How are we? Welcome. Sunday evening. Hope everyone's all right. Thanks for being here. There's a good, well, it's 11 of you on here already. This week is an interesting one. This week was actually Talk Money Week. And if you worked in businesses, they may have had financial programs on. I did one for Co-op this week, and we were talking about investing specifically. I just think it's really, really nice to have companies actually put on workshop for their employees to help them be a little bit better with finances and stuff like that. So you probably saw the hashtag trending through the week and stuff like that. But I'll be interested to know: did you have any of your employers, put on any financial literacy or financial well-being workshops for you this past week gone? Because yeah, it'll be interesting to see. But yeah, welcome guys. Matt, Marky, Yinka, how you doing? Michael's also on here. Grand Singh. All right, there are already some questions in here, so let me get to these and start from the top. I think Kev got one in here, but because it's in early, I can't pull up on the screen. But Kev is asking, Evergrande is up 20% in the last 5 days. Could this be a massive buying opportunity? But I don't know how I'd buy. Simply Wall Street have an incredible 99.3% undervalued. If you're willing to take the risk, by all means. The fundamental fact that the business is in trouble still remains. So I'm not sure that I would view it as a buying opportunity because the fundamentals they're still in a heap load of trouble. So I'm not sure that it will be a buying opportunity for me, but it may be if you're happy to put some money into it and potentially have a little bit of a gamble. But yeah, it's probably a little too high risk based on some of the fundamentals for my liking, but you could always have a punt if you want to. Jamie is asking, is it worth buying the Warren Buffett stock B, class B? So you're talking Berkshire Hathaway there. Yeah, I mean Berkshire Hathaway. It's just a different class of shares, effectively, that you've got in there. So let me see if I can actually find, because the Class A ones, the stock price is ridiculous. It's crazy. I think it's something like 450,000 for the Class A shares. So the Class B are the ones that you can access at a lot more of a palatable price, essentially. Berkshire. I'm looking at, yeah. So here we go. So B, we've got B and A here. Yeah, so Bs are about $285 roughly a share. And actually, the chart doesn't look too bad in terms of it's Berkshire Hathaway at the end of the day. It's Warren Buffett. He's done very, 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 very well. But yeah, $285 versus, let me just double check what the Class A shares are. Yeah, I'm just going to share this with you because it's absolutely insane. The price of this. Look at that. It's $431,000 a share. It is absolutely nuts, that share price. So yeah, Class B would probably be, a more palatable way to access some Warren Buffett holdings. But yeah, nothing wrong with that at all, mate. Right, let's get to the ones that I know that I can actually share on screen. Thanks for this, Yinka. Really do appreciate it. Thank you very, very much. Good to have you here as well. Michael, let's have a look and see what Michael's asking. Do any dividends count towards the ISA 20K, e.g., invested 19,000 and get 1,000 dividend? Does the 1,000 pounds count towards your 20K allowance? Well, of course, numbers just for illustration, 1,000. No, it doesn't. So your ISA allowance is a contribution allowance. So you can contribute up to £20,000. If you get dividends or any returns of any kind, it isn't accounted for in your 20,000. So in this example, no. So you could have 19,000 that you paid in, £1,000 in dividends. you will still have an additional £1,000 to add in because you physically haven't contributed that £20,000 limit. So the remaining 1,000 will be your allowance left for the year. Hope that makes sense. Pictures freezing. I don't know what that is, mate. I'm playing around with actually the last time. So I've had issues with this software that I'm using. So before it was a constricted kind of view that you would see. I managed to fix that, but I've been researching another one which will give you better quality so that the picture doesn't freeze. Because I'm looking at this right now on the other side of my screen here, and I can see that it's not as clear as what comes out of the camera. So I'm actually going to be looking at maybe moving over to a different provider for the live streams like this in the next week or so. I was going to use it today, but I needed to try it out first beforehand. So apologies if it is freezing, guys. Not much I can do in that regard, unfortunately. Grant Singh's asking, do you think Hargreaves Lansdown fees are too high? Which stocks and shares ISA would you recommend for a combination of stocks and index investing? I'm currently with Hargreaves Lansdown, but wonder if it's the best place for me. Their charges can be a little bit expensive. It depends on who you compare them to, though, mate. Yeah, and it depends what you're looking to access. If you want stocks, you want to be able to pick your stocks and invest in index funds and ETFs, then they are a very, very good provider. If you go to Vanguard, you can't pick the individual stocks. If you go and compare them to maybe the likes of Trading 212, if you don't have an account already, then you're scuppered there. If you've got an account, then yes, you can access individual stocks and some index funds. But I believe even on Trading 212, they haven't got all of the index funds or ETFs available. If you then go and have a look at Free Trade, for example, yes, you'll be able to access individual stocks and some index funds and ETFs, although they do put some of the good index funds and ETFs behind the paywall. So you may have to pay extra there. And then you're getting into the realms of the likes of eToro, where there's a limited number of index funds and ETFs you can access there. Beyond that, you're then going towards providers where it's going to be managed on your behalf. So essentially, you're going to be limited in terms of your ability to pick stocks. So you're trying to get the balance between picking stocks and being able to pick index funds as well. There isn't that many providers that will give you the balance of the two. I mean, even if you look at Invest Engine, you can't pick individual stocks with them, although some of the ETFs will be way, way cheaper because all you're paying for are the cost of the ETF specifically, minus any platform fees and transaction fees and stuff. But then, even with Invest Engine, you won't be able to pick your own stocks. And that is going to be problematic if you're trying to contribute into an ISA under one platform, because you can't have a stocks and shares ISA with Hargreaves Lansdown for your individual stocks and individual stocks, for example, then go and have an ISA with somebody else for your ETFs. You can't do that. So whilst they may be high in fees at this point, or they're expensive, it's because they know what service they're providing. They're allowing you to access individual stocks, pretty much all of them that you could ever think of finding, and you're also going to get the ability to access a very wide range of index funds and ETFs. So because they're providing both of those things under one umbrella, they set their price to what they feel is appropriate and fair to them as a business. It's a catch-22, mate. It's really, really hard. And it's not an easy decision to come to on who you're going to basically use, because all of them do different things and they provide different levels of services. So it's difficult, mate. Ranston, hi Pete. Do you know if I can open a money box LISA and a free trade stocks and shares in the same tax year, as I've already opened a free trade ISA? Thanks, Brandon. So you can have a lifetime ISA and a stocks and shares ISA. That's fine, separately with money box and free trade, because obviously your overall allowance is going to be 20,000, and your lifetime ISA will consist of £4,000 of that 20K. So yeah, you'll be fine to do that. That shouldn't hurt you at all. I'm guessing what you're mentioning here is you've already opened a free trade ISA. I'm assuming that's a cash ISA, but on that front, you'll be fine. It's not a problem at all. Hey Asif, how you doing? Cheers, Marky. Thanks for that feedback, mate. Can you comment on CBS and Discovery stock? Feel they're undervalued. What's your thought? Thank you. Well, I haven't done any kind of an analysis or look into them specifically, so I can't give you a detailed view. TV channels are a weird one because it's all about advertising is their main source of revenue, right? So obviously advertising will be, and the rates that they charge for advertising will be based on if they're running a subscription model or their viewership numbers. Without looking at what those numbers look like from a financial point of view in some of the fundamental research you would do, it's hard for me to say. I don't have either of those, to be fair. The ones that I do have Disney, because I think Disney as a whole, especially if we start looking at things like metaverse, they're going to be a big player in that. The Marvel Cinematic Universe, they're big on that. When things kind of open back up again, the whole resorts and things that they're able to do there, it's a multifaceted business. I don't know how multifaceted Discovery and CBS are. Oftentimes they're part of bigger conglomerates as well, so they might be owned by somebody else because they're all interconnected in that way. So I can't really give you like a proper full nuanced kind of a train of thought because I haven't looked at Discovery and CBS specifically, but I would be looking at revenues, that kind of stuff. I mean, if they are undervalued, why are they undervalued? What's the reason behind them being undervalued, and where is that actually coming from? What's their growth trajectories? That kind of stuff is what I'll be looking for. Here we go. There's an MCU fan here. Thoughts on the Eternal movie? You know what? I how many times have I seen it? Have I seen it twice already? I think I've only seen it once. I have only seen it once. I like it. I do like it. I think some of the sequences were amazing. The world building is amazing. I just don't know. I just feel as though I want to see how it's going to fit into the wider picture of the MCU after everything else and how it connects with the rest of the films. I felt like it was almost this standalone movie that didn't fit in that well. And I don't know. It's just like, it's little things that I just thought they could have done things better. And it's a long film as well. It's proper long in comparison to some of the, other ones that you would think as being the first movie. There were too many characters in it. I don't think that you really got to know either of the characters really that well. But yeah, it was a good movie. I'm probably going to go see it again. But I'm interested to see how it's going to fit into the wider universe. How does it fit in with, Spider-Man and No Way Home? Are we going to see anything to connect it so that we can see where it's actually going in the biggest scale of things? And that's been their strength the entire way through. Like from Iron Man all the way up into the Last Avengers, they've been able to interweave these characters. And I just don't see where the Eternals fit within that picture just yet. Evening, Edna. How we doing? Right, okay, let's have a look at this. How do you choose investments on Fidelity? What are the features of a good investment? Well, regardless of what provider you're using, the fundamentals are still going to be exactly the same. It depends what you're trying to pick in Fidelity. So if you're looking at kind of like index funds and ETFs, for example, you should be looking at the cost ratio. You should be looking at some of the past performance. You should be looking at the objective of what you're looking to buy and whether that ties into your objective as well. And then just doing if you can, because a lot of the Fidelity funds may be replicated elsewhere. So you might have a Fidelity, for example, S&P 500. It might be built slightly different to a BlackRock or a Vanguard one, but you just want to do a little comparison there just to see, do they have little allocation differences. So might they allocate a little bit more to Tesla or a little bit more to Google, for example, in their top 10 than, say, BlackRock or Vanguard? Little things like that may eke maybe just a little bit of extra performance out, depending on how the individual companies that basically perform. But you definitely want to be paying attention to the key information document, the key investors information document. You definitely want to be paying attention to that, and just obviously pay attention to a little bit of the cost analysis within it as well. The big thing here is making sure that whatever you choose essentially fits with the way you want to invest in your goals and your strategy. So make sure you read the objective of the fund. Just don't pick one because it's popular, if you will. Make sure it fits in with your own objectives as well. This is a good one from Sebastian. Which cashback credit cards would you say are the best on offer at present? Mate, I couldn't tell you because I do not use cashback credit cards at all. I don't use any. Well, actually, I do have credit cards. I just don't use them. I have not used the credit card now for best part of maybe 6 or 7 years. I just don't use them. I'll tell you who you could look at. I had Andy Webb on this Wednesday. His blog is very, very good for things like that. So if you type into Google, be clever with your cash, he has a section on his blog where he talks about cashback credit cards, that kind of stuff. He will be a really, really good resource for you. But yeah, I haven't used the credit card in God knows how long. I have them, but I just don't ever use them. To be fair, I could probably use it a little bit more to keep my credit going, but I'm at the point now where I have zero debts apart from like a mortgage, a small mortgage. That's it. That's the only debt that I have. I'm pretty self-sufficient in terms of income, so I haven't had any real reason to use credit cards. I could use them for maybe air miles a little bit more, but I just don't at this point in time. Manuel, let's see what you're asking. I have the VWRL, S&P 500, Emerging Markets, ETF, VFEM, and I'm thinking to put all in the S&P instead of having 3 funds. What do you think? You're going to shift your asset allocation entirely into the US, which if you're happy with having all of your money invested in the US, then go for it, mate. But I think where you are right now, you've got the global diversification. So you have your money invested in more than just one country and one region. You're looking to get rid of all of that and put it into one country. So you're betting on America, basically. If anything happens with the Fed, inflation, the economy, anything that's outside of your control, that means that the American market takes a hit, you're probably going to feel that. So I would say that's maybe a high risk strategy, having all of your money in that one geographical region. But if you're happy with it, then by all means. But you need to be careful, mate, really, to be fair. Risk diversification is really important. You'll be putting all your eggs in one basket. Yeah, the Class A is the most expensive stock there is on any index. It's ridiculous, and the reason for that is because I think Warren has this idea that it puts off people who aren't serious about investing in his company in the Class A bucket. So the people that you have in there will have like literally mega, mega, mega bucks, but it is the most expensive one that's out there. And he refuses to do a stock split as well. Niam, how you doing? Thanks for doing the live session and sharing the Cryptopia. I learned a lot. One question comes to mind: Is crypto goals to be peer-to-peer transactions or store in value? Thoughts? Can you elaborate on what you mean, mate? I'm not sure what you mean there. Is crypto's goal to be peer-to-peer transactions or to be a store of value? I think it depends on the coin that you're looking at, mate. So I think Bitcoin, even though I think in the early days it was meant to be this crypto that you could use on a transactional basis, I think the the user case for crypto has kind of evolved from that to being a store of value, a hedge against inflation. I think that it's just happened to find itself in that place in terms of a user case when you contrast it to where it began, and that's just by circumstances, the 21 million supply, the way it's been coined as this digital gold, and the way that I guess it's deviated from the markets, as if you will. It's no longer running really in correlation to the market. So I think it depends on the coin that you're looking at specifically in terms of the user case. I mean, I think, if you look at Ethereum, ETH, for example, what is it? It's a digital platform at the end of the day. You can build apps on top of that, which will facilitate all kinds of things. Metaverse, DeFi, it will facilitate a lot of things. So it really depends on what coin you're looking to purchase for its actual user case, because all of them will have a different user case, essentially. Hey, what's going on, GT? How you doing? Yeah, you know what? I've not even had a look at it. I've not had a look at it for a while. I'm sure it's doing okay. I'm sure it's still up, but I just don't know how much it's up by. I know that I'm not going to be in the red because I don't think the S&P 500 has taken that much of a dip for it to be in the red. So yeah, I can give an update on that. Hi Pete, was wondering what your thoughts are on S&P 500 US equity index fund. The share price at the minute is 783 compared to 66 for the S&P 500. How important of a factor is this? So the Vanguard US equity index fund. One sec. The price that you're seeing there is simply just like it's just a trading price, really, to be honest. So don't let that be, thinking if one's 800 and something, then the other one's 600, that all of a sudden one is better than the other just on that price. Don't use that as your core deciding factor. But let me just have a look at the where are they? The US equity index fund. Okay, I'm definitely in the wrong place here. Where are we? Index funds and active funds. US, UK, Japan, USA. Let's have a look at this. Okay, so this is what we've got. So you're trying to compare it with the S&P 500. So one thing that's worthwhile bearing in mind, let me just hide this. So one thing that's worthwhile bearing in mind is this. So this particular index fund is invested in 4,000 stocks, so 4,000 companies altogether. That's the price ratio. It's a risk level 5. Forget this for the time being, but remember this, 473,000 companies. So when you go on to things like the portfolio data here, what you'll find is you've got a breakdown of where it's actually invested. So IT is going to be the largest because obviously it's in the States, but these are the top 10. Tesla, Nvidia. I'll be very, very surprised if this is different to the S&P 500. It will probably be exactly the same, but you do have over 4,000 stocks within this. So if you go and have a look at, and the S&P, so this is an index fund, by the way. So with an index fund, remember you've got slightly less flexibility to trade in and out of this. If you wanted to get out, you've got to wait until the end of the day. But the price point is still pretty okay. It's 0.10%. But let's go and have a look at the to find the S&P 500, because that's an ETF, and that's important to bear in mind. So let's do the VUSA. Is this one right here? See, that's only invested in 509 companies. So you've got less companies that you're holding here, which, many people will argue that it could be positive and negative, right? These are the top 500 companies, 509 companies in the world. you've got a more of a concentrated holding to these 500 companies, whereas in the other one, you've got, 8 times more companies. So you've got a whole host of other companies that you're invested in, which could arguably help you diversify your risk, but it could also dilute your returns as well. The price point for this is obviously low because it is an ETF, so it's 0.7%. So the question, I guess, for you is if you've got the equity index fund, where do you feel more comfortable? Do you feel more comfortable having more companies that you're invested into 4,000 versus the 509 in the S&P 500? And if you look at the comparison in terms of the actual performance here, let me just see if I can just run this very quickly. Let me just write this down. Right, so far this year, 42.52 plus. I messed that up. Right, 1 second, guys. I wanted to see if I can just take an average of this very quickly, because I want to see if holding those additional companies actually has a material benefit to what you're seeing in the performance numbers right here. So, is it better off in any way, shape, or form, or does it not really make any difference at all? Okay, so that's 95.6. That one's done. Let's write that down. And this is the S&P, 95.6. I'll just go back. I want to go back to this one right here, 35. So what you'll see here is if we did a side by side of this, I mean, this was definitely a worse year, and you could argue that it had better performance because it had more companies that was invested in potentially. But let's just have a look and see what the average of this is. I messed that up again. Okay, so this is 80.60. It's done over that 5 years. So this has actually underperformed the S&P 500. So you could argue, like I said, the concentration of stocks that you have in the S&P 500 and them being the largest companies in the world could have facilitated essentially that it's performed better than this one right here. But this will give you, I would argue, a smoother ride. So that year in the S&P where that was like 6% or something like that, you would have had a better year here. But overall, and the thing is, this past performance is no indication of future performance. Do you want a concentration of your stocks within a basket of maybe 500, or do you want to cast the net over the 4,000 companies that this is invested in? It's a hard thing to choose. Again, what I would say is you need to go back to your goals. You need to go back to what you want to achieve and whether you feel that index fund or the ETF is the best vehicle to help you get towards your goal. And remember, if you're invested and you're reviewing it on a year to year basis, you can switch, you can change if you want to. But I think the most important thing is, make the decision that you feel most comfortable with and monitor it. If you wanted to, you could split your money 50-50 between the two of them, or whatever split that you want, but do what you feel is important. But don't look at 783 quid as your buying point. Don't worry about that doesn't matter. What matters is the content of what the fund is actually invested in and how it's actually invested, past performance, what the goals are, for example. So yeah, just bear that in mind. Just trying to find the next one. Let's have a look at this one from GT. Right now, my entire portfolio is based on index funds, mainly the S&P 500 and not individual stocks. I want to keep it that way for foreseeable future. Is it a good idea? Love index funds. Index funds are low cost. They're going to give you the ability to diversify. And this is the thing that I always say. If you're holding individual stocks, you have a concentration of risk in there. So within that ethos and that theory of trying to build a portfolio of individual stocks, you have to be well researched and you have to be mindful of how you're going to diversify. So, do you have 10 stocks, 20 stocks, 25 stocks? Most people will argue that you need 20 stocks, maybe 25 stocks to diversify adequately if you're picking stocks individually. You've got to do the work for that, though. You have to understand how that actually works. So, doing the research and compiling it and deciding that actually, how are you going to allocate your money from a percentage point of view to those companies? Reviewing it is also your responsibility, monitoring it on a day-to-day basis. Whereas with an index fund, it's very, very easy. You literally put your money there and it will do what it does. And it helps you with the diversification a little bit more. Look, my approach, I may be a little bit biased, is a core satellite approach. So most of my money's in index funds and ETFs. Then I've got money in individual stocks. I prefer to invest that way because it means that I don't have to do a lot of the heavy lifting. And even though I do know what I know, I'd rather be doing other things during the day than, worrying about what my investment portfolio has been doing. How many times can you transfer an ISA in a tax year? There aren't any number of limits that you can do that. But honestly, mate, I wouldn't do it more than once if you can help it, because you've got to remember, when you transfer from one provider to another, they have to disinvest your money, then send it across. So they have up to 30 days. And some people do take longer than 30 days. So if you're transferring 3 or 4 times in a tax year, then potentially you could be out of the markets for 3, 4 months. So whilst you're out of the markets, obviously you're not getting any growth. So you could potentially be doing yourself a disservice by not being diligent in selecting the person that you want your ISAs to be with. So I would do it maybe once a year, twice max, but just don't keep moving them like 3, 4 times a year. I don't know anyone who has done that. I'm not aware of any limits on it anyway. Interesting. See, you're the second person I know who's actually doing this test. Actually, you message me on IG, Edna, and let me know how you're getting on with that. Because I know someone who actually needs to take it as well. So yeah, let me know. It's interesting, really, because you hear different stories about what questions they ask you, like historical questions and all that kind of stuff. But I don't know whether they've changed it or not. Let me know. Right, let's answer this one from Richard. My wife has a stocks and shares ISA in Invesco, but all dealings seem to have been made over the phone. The fund is 1% plus. Do you recommend a switch to Vanguard from Invesco? Invesco are very, very expensive. They're one of the old school premium providers out there. Look, whether you should switch, I can't advise you to switch, obviously, because there are other considerations, but 1% is a lot, especially if you're only dealing with people over the phone. I mean, if you're going to be paying 1%, you should be seeing someone face to face. I mean, you could pay a financial advice, and you're saying 1% plus. That's a lot, mate. Just on a cost comparison straight away, you could move to Vanguard and pay a whole lot less, which means that actually there'll be more money in your pocket because you're not having to look at your returns and take 1% plus off your gross for a net return of whatever that might be. So yeah, there are good grounds to move and switch to maybe someone like Vanguard, but just make sure that you understand what you're invested in currently with Invesco, so you can find maybe hopefully as close as you can to a like for like. And if it is in an ISA, please don't close the account. You're saying it is in an ISA, so please don't close the account, take the money, and think you can go and pay it into Vanguard. You won't be able to, especially if you've amassed more than 20K in there. So do a transfer, which means if Vanguard is your preferred provider, you need to contact Vanguard and ask them to transfer from Invesco. You simply just fill in the form, give them the Invesco account number, and they should do the rest for you. So yeah. Thank you so much, marketing. Really do appreciate it. Let's have a look at this one. My work pension is an LNG multi-asset G25. That, you know what? That's not a bad fund. That's not bad. LNG are pretty good. LNG are very, very good. I'm 37. I don't think it's performing. I don't think its performance is aggressive. I want to switch funds and maybe provider. Is it possible? How do I better pick a performing fund? Okay, so if you're with LNG, hang on one second. LNG multi-asset G25. G25. They've got different variations of it. They've got PMCs, they've got Fidelity. Right, hang on a second. This is a fund summary. Let me see if it's this one. Yeah, it will be this one because this is the workplace pension option. So let's have a look and see. I'm pretty sure this is the right document, but I could be wrong. Do have different versions of this. The best way that you'll be able to do this is that your particular fund that you're in right now will have either a CEDOL number, which is SEDOL, or an ISIN number. So ISIN. If you can find any of your paperwork and get that number, put that into Google, you should be able to come across the actual relevant documents for it. What I want to do is I want to try and see if we can ascertain what risk level they're at. Because they have a lot of different funds in here. It's global markets, global equities, equity funds. Yeah, I'd need the ISIN number or the CEDOL number to know for sure. But I mean, look, in answering your question really, really quickly, I thought I might just be able to have a look quickly and just give you a few thoughts here. If you're looking at moving it to another provider, yes, you absolutely can. I would encourage you to have a look at the other options that LNG have, because they have a multitude of options. If you're literally just looking to up your risk profile or where you're invested from a risk point of view, you're going to have lots and lots and lots of options in LNG, and you can filter them as well according to cost. So do you want it to be passively managed, actively managed? You can do all of that filtering within LNG when you sign in, and you can then select. And for you to switch, they don't charge you either. So maybe have a little look around LNG first. If you want to move to another provider, you absolutely can. You just want to make sure that you've identified maybe where you actually want to go specifically and what you want to invest in. So, for example, I do have an LNG fund. I've got one of their Future World funds. It's done very, 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 very well, which is why I'm saying have a look at the options that they have, because they have so many options there. But just number one, try to understand what level of risk is your existing one at. Is it balanced? If you want to go higher, then you need to search for options that will give you exposure to on a higher basis. Once you get to that point, then maybe just have a look at a handful of the funds and make your decision from there. But if you did want to transfer, it's easy to do. Or you can do, I mean, there are people like Pension B, for example. There's Pension B. Who else could you actually switch to? You could move to Vanguard if you wanted to. They'll be really, really low cost as well. Whether they're going to have the exact kind of funds that you're going to have with LNG, probably not, because you're going to be limited to the ETFs and index funds that they have available. So, for example, if you wanted something that is thematically themed, so it's themed to have exposure to future world. In my case, where I'm invested, you're not going to get that with Vanguard. So maybe kind of get an understanding of like, where do you want to be invested? Like, do you want ethical investment, future world investment, or are you happy with where it is, but you just want to raise the risk? Decide from there, use that as your selection criteria, and then decide. If you want to move, you can move. But yeah, you just have to go through the correct steps in order to do so. Looking for credit cards to raise my credit score early to make it easier to get mortgages and insurance. No bank will even consider me due to my age, 18. What other ways can I raise my credit score? Okay, so Matt, a couple of things. If you're not already doing this, you should go and have a look at apps like ClearScore, maybe. ClearScore, really, really good. It will give you access to your credit score. And because your credit score updates every 30 days, it will update you every 30 days with any improvements or detractions from your credit score as it currently sits. What it will also do is, after maybe a month or two, or maybe three, it will also start to connect you with credit cards that are likely to accept you based on your current credit score. Word of a warning, you're probably going to only get access to like the credit cards that have very, very high APRs, but the app will try and match you as closely as possible to one that will accept you based on what your credit score is. So maybe download ClearScore and start from there, see how you get on. The other ways in which you could immediately have a bit of an impact on your credit score. I don't know what your living situation is. If you're living at home with your mum and dad, make sure you're on the electoral roll. If you're renting a flat, make sure you're on the electoral roll. Because whenever you go and apply for like a credit card or loan or car finance or mortgages, they want to know that they can locate you and they want to know where you've been. So if you've got a track record of having lived at an address for 2-3 years, that gives the lenders comfort in knowing that you're not just some guy that doesn't have a track record of where you've lived. You're kind of like a nomad, if that makes sense. So that immediately will give you a bit of a boost. So make sure you get registered on the electoral roll. That will give you an immediate boost if you can. And then, yeah, ClearScore should be able to help you from that point onwards. If you are paying rent, some of these apps these days actually aggregate your rent and actually report your rent to the credit referencing agencies. I'm actually going to be covering one in the next couple of weeks, which actually does that. And what they basically are an aggregator. So if you have like cash accounts, investments, savings accounts, all of this stuff over the place, they aggregate all of that information and they can actually send your rent payments as proof of, your commitment in paying a bill to the credit reference agencies as well. So maybe a couple of things there that will help. Interesting. We've got a DB pension. I have a DB pension, basic rate taxpayer. My next move after building an emergency fund and paying off all consumer debt was to open a stocks and shares lifetime ISA. What do you think? All right. Okay. Look, we can get into some really interesting stuff here. Right. So you've got a DB pension, which means I'm assuming you're going to be kind of older, maybe in your 50s or so, maybe late 40s. There are a couple of considerations here, okay? So this entirely depends on how much you're earning right now and what your earning capacity is. So with a lifetime ISA, the maximum you'll be able to pay in is £4,000. Now, if you don't already have a lifetime ISA open, you may not be able to do it because I think the maximum age for a lifetime ISA is 40. Let me just double check that. I'm sure it's 40. You have to open it before you're 30 or 40. So I think it's 39. Let me just double check it. Make sure I'm not telling porkies here. What's the eligibility? Go on. Show it to me. You would think it would just be really, really easy to find on here. Bear with me for a second. Yeah. So if you're over the age of 39, if you're over 40, you can't open a lifetime ISA. So if you were looking at a lifetime ISA for the purpose of obviously boosting your retirement funding, you won't be able to use that. which will then lead us to the very next option, which will be like a SIP, self-invested personal pension, which you could get via Vanguard, um, a whole host of other providers, Pension B, Moneybox, a whole host of them, right? So the reason why I was going to talk about lifetime ISA was because that is capped at 4 grand. And yes, you get the £1,000 free from the government, but even within the pension, you're going to get tax relief. So if you're a basic rate taxpayer, you're going to get 25% anyway on your contributions into a pension. So you won't be able to do a stocks and shares lifetime ISA if you don't already have one open, unfortunately. But if you did, and you were going to compare a lifetime ISA and a pension, the main thing that I'd be asking you is what level of contributions would you be paying into it? If you think you're likely to breach the 4,000, then you definitely need to be having a look at a pension. If not, then a lifetime ISA would still actually work quite well for you. The beauty of a lifetime ISA is you could get the money out if you wanted to before the age of 55. Whereas if you are in a pension paying into a SIP of some kind, you wouldn't be able to access it until 55. So if you're younger than that and you might need access to your funds, then a stocks and shares lifetime ISA may be a better bet than an actual personal pension or a SIP because of that accessibility. Just bear in mind, though, that with a lifetime ISA, if you are going to access the funds early and it's not for income purposes, then obviously you forfeit the £1,000 bonus that you get from the government because you're not using it for the purposes of income in retirement. So just a couple of things for you to bear in mind there, mate. Let's have a look at this. I went through your financial course. It mentioned tax on personal savings accounts. How does it work? I have an everyday savers account worth 20 to 25. Will I have to report this to HMRC? Yeah, so the savings allowance is very, 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 very small. It's not a large amount of money, mate. I think it's something like 1,200 or something like that. It's not a lot. It's not a lot at all. So if you've got anything in savings that is outside of your ISA, if you've got interest, then you will have to report it, unfortunately. So yeah, I mean, if you've got that, I mean, I don't know your situation, I am, but if you've got that, I'll be looking to put that into an ISA if you could. And if you've maxed out your ISA, if that's emergency funds, maybe have a look at premium bonds because that will be tax free as well. You can get access to it in pretty quick order if you needed it. But yeah, I mean, look, if it's in a savings account, you probably haven't got a lot of interest anyway, so you won't have to report it unless you've got, you know, a return, an interest return higher than your savings allowance. Let me have a look at this. Actually, let me just confirm what the savings allowance is. I know it's very, very low though. It's not a huge amount of money. Where is it on here? Yeah, so a basic rate payer it's £1,000. For a higher rate payer, taxpayer it's £500. So yeah, it'd be about £1,000 max, really. And there's a follow up here on CGT. Correct me if I'm wrong. Is it to do with all assets combined, or can it be individual that is worth and sold over? So it's assets combined. So if you've got index funds, ETFs, individual stocks, crypto, it's your gain across all of them. So the minute your gain across all of them exceeds the 12,300, you need to be reporting that to HMRC. The big question that often people are asking is, well, how do you actually track it? It's your responsibility to track. You need to know when you're breaching the 12,300 mark if you've got money invested. So you just need to be mindful of that, but it's not on a one individual thing. You could technically breach your capital gains on one of your holdings. So for example, if you had Tesla and your Tesla returns have done more than 12,300, immediately you're going to have to announce that, but then you still have to add on everything else as well. It's really, really important just to bear that in mind. Would you invest directly in the Vanguard or in the trading app if you want to invest in ETFs? What do you mean? I'm not sure I know what you mean there, Mustang. Would you invest directly in the Vanguard or in a trading app if you want to invest in ETFs? Well, as long as you, I think I know what you mean there. So, I mean, as long as you've got the ETFs that you want, I mean, look, if you're using a trading app or Vanguard, that's provider choice, right? You're just choosing between providers. So that will be down to you as to whether you think you can get access to better or more of a range of ETFs using another trading app other than Vanguard. There's no right or wrong in it. You just have to pick what you feel is best for you. Um, all right, guys, do us a favor if you can. Yeah, with us 29 likes at the minute. So if we can get that up, that would be absolutely fantastic. Thank you. Um, yeah. Yeah. You know what? It's nice that I think I know that he's got a videographer. I know that he's got like maybe one or two people that actually help him out with all of his channels and stuff like that. That video did seem like it came from him though, because I know that he does spend time actually replying to comments himself. I couldn't believe it, to be fair, because I was like, it's got to be a fake account. But then I clicked on it, it was him. So it's nice to him to actually take time. But then again, I was talking about him in the video, and I know for a fact that when I took clips from his video, YouTube would have flagged that to him to say that there's a video that is using your content. And from a monetary point of view, monetization point of view, he would have then either have said, well, demonetize that account, which I knew could have happened. But I was like, you know what? It doesn't, I don't care. The reality is I was going to use parts of Sasha's videos as well. But the last time I spoke, well, the last time I made a video where Sasha thought that I was talking about him, he did a community post where he basically slated me. So, and he would have tried to get the video taken down or demonetized. So that's why I didn't use his. But it was nice of him to be in the comments. I think he commented twice or three times. It's a big YouTuber, really, really big YouTuber. So yeah. Any question? Last question. Any other active management funds like Money Farm? Thanks again. Actively managed. You've got the likes of Nutmeg. They've got an actively managed offering in there. They've got the JP Morgan fund. There's them. See, you're talking providers specifically with active management. I'm just trying to think of them now. Nutmeg, Money Farm. I don't think Plum have an active management. No, I don't think they do. No, those are the two that come to mind. Money Farm and Nutmeg are the two that come to mind straight off the bat. I'm sure there's more, but I just can't think of any that I've actually covered myself on the channel. So yeah, but Nutmeg have been really, really good for me. They've done very, very well actually. I think I'm probably about maybe 14% or something like that. I'm still with them at the moment. At least that was the last time I checked when this came up in conversation through questions. I'm just going to have a look now. Yeah, I'm up 14.12%. So not bad. And I've only been with them since February, something like that. So they've done really, really well. Yeah, there is a difference between an accumulation fund and a dividend paying fund. So an accumulation fund will basically mean that anything that you get, so your returns, your dividends are automatically rolled back into the investment and reinvested. Dividends will basically pay that money out in an income. So you'll see that money sat in a cash account or distributed to your account if you've left that instruction. So they're very, very different. It means that on a dividend, if it's paying it out to a cash fund, you would have to physically reinvest that money yourself. Right, I'm just conscious of time now. So I'm just going to skim through some of. Okay, there's quite a few that I've not actually got to. Apologies, guys. I'm just going to see what if I can just get to the bottom and maybe pick out another 3 or 4. My eToro account is actually doing really, really well. It's up massively at the moment. I've been using it more and more and more. I've actually rejigged things a little bit. So I've got quite a bit of crypto in there at the moment. So it's doing really, really well. Okay, let's have a look at this one. I invest in the global all cap index accumulation. Should I invest in something alongside this, or is this just fine? I use Vanguard as my platform. I want to invest long term, so need a good fund. Yeah, I mean, the all cap is global. You're going to get a large cap, mid cap, and small cap in there as well. So you're going to see some swings, I would say, because you've got small cap in there. So small cap would be more volatile than maybe some of the large caps, but that's not necessarily a bad thing. Volatility can be good. It means that small cap might fall, but when things turn around and do really, really well, you would see a nice uplift in the small cap. Same thing with mid cap in the run up to that ladder. So the key thing here is, are you comfortable with your selection? That's the most important thing. The question of whether you should invest in something should be answered by a question back to you, really, in that you've got that investment right now. Do you sleep well at night? Are you at peace, or are you worried? If you're worried, okay, then I'll be asking, why are you worried about it? But if you're happy with it and you think, actually, I'm cool with the money being here, then you're in the right place. There are no right and wrong answers here. The big thing is to make sure that you do and you put your money in a place where you feel comfortable, where you feel as though it's going to do the best job for you and you're happy with the risk that you've taken as well. This is a good one. Not one that someone's actually asked before. Innovative finance ISAs. They are very, very good. They allow you to invest in, things like startups. There's more risk in them, essentially. But if you're happy with taking a high level of risk, so a little bit of a gamble, if you get good returns from it, and they could be very, very good returns if they come off, it is essentially tax free. So higher risk because you're invested in pretty much new budding companies, really, to be fair. But if they do well, then the returns could be very, very handsome, and it will be completely tax free. Yes, you could, Edna. What I would say is, drop me a message, because now that it's embedded into my website, what I can do is I can create the account in the person's name, and then you can send them the login details for it. So yeah, just message me on IG and I can set that up. Not a problem. All right. Okay. Let's have a look at. Let's have a look at this one. Hi Pete. Next, FYI, financial year, I will be a higher rate taxpayer. To avoid high income child benefit charge and to avoid the 40% tax, should I do a SIP instead of my usual stocks and shares? Cheers. Mate, I wish I could give you a very straightforward answer to this, but I don't know your entire financial landscape to be able to say you should definitely do X, Y, Z. I assume you're not employed. If you are employed, then the question will be, can you do maybe more of a contribution into your pension than you are? Salary sacrifice. There are a number of things you could actually do, but it's very, very hard for me to say do X, Y, Z without understanding your full financial situation to be able to say, okay, these will be the key things for you to bear in mind, Ralph. Yeah, I mean, this is why people argue, well, is it worthwhile going up a tax bracket and taking a pay rise sometimes? Because in terms of your take home and the things that you potentially lose, does it put you in a worse place? So trying to offset and compensate other things becomes really, really important. It may be, there are so many things you could do. I mean, things, I don't know if you're married. like properly married. If you're married, then there might be other things you could do there. It's hard to say, mate, without knowing your full situation. Because if you're married, there are things that you can do with your wife where you can transfer some things over to make that tax position a little bit more tangible. But without knowing any of that, I can't really give you a proper answer. Okay, let's have a look at this one. Okay, we're about an hour in now. Can you explain what the first, second, and third quarters are and why it's separated into these four quarters? They're basically reporting periods, mate. So the first quarter will be, sort of, January to March, then April all the way to June will be second quarter. So it's every 3 months, pretty much, right? So you've got four quarters in a year. So it's 12 divided by four, you get 3 months. So each quarter is 3 months, and that's reporting period. So essentially, some companies will report their returns within a quarter, but it's just a way for you when you're looking at investing and looking at your investments to understand that on a quarterly basis, are you up, are you down, what's going on at any given time during that quarter. All of the funds do that because, in opposed to looking at it after 1 year, there'll be things that will happen during the calendar months and within the quarters that may mean that you need to shift investment kind of like approaches. So they will monitor things on a quarterly basis. So when you're looking at maybe some of the top quartile providers, they'll say in Q1, this is the top person, but they might not be the top person in Q2. It's simply just a reporting mechanism. Let's have a look at this one from Liam. It's pension day on Thursday. I'm meeting with my pension provider. Should I rotate out of my default funds and put together a couple of diverse funds, e.g., US, UK, Europe, emerging markets? Listen, mate, if you're in the default fund as it is, you definitely want to have a look and see what else you've got, particularly if you've got, 20, 30 odd years to retirement. You definitely want to be looking at better, more adventurous funds, because the reality is you can't touch it till you're at least 55 by law. So if you've got that amount of time there, you might as well have your money working as hard as possible for you, like really, really working hard. So yeah, ask the questions, see what else they've actually got, and see where else you can get to maybe some better exposure and potentially some better growth, really. And ask as many questions as you possibly can about, the funds and how are they all managed and the fee structures and things like that. Kevin's asked it about Dave Ramsey still uses mutual funds. I think it's because he'll get offered better, cheaper fees than the regular population. What do you think? No, I mean, oftentimes these funds will be tiered based on how much you invest, but apart from that, he won't be privy to any special rates. You're not really allowed to do that in the industry now because it's all about treating customers fairly. But he is in the States, so it might be slightly different rules. But here in the UK, you can't really do that. You can't offer one person a different rate to this person. Yes, they might be tiered. So they might say, okay, if you invest in 20 million, we'll reduce the charge because obviously they're making more money and more money is being invested. So that makes sense. But you can't typically just negotiate a better fee or rate. Okay. Geez. Okay. There's quite a lot there. All right. Let's take one or two more. Where are we? I just lost where I was there. Okay. Let's answer this one. What happens to my pension if I die? So, your pension does not die with you. So if you are in a workplace pension, so this is one thing that everybody should do. If you're in a workplace pension, they would have asked you, or they should ask you to nominate your beneficiaries. So when you nominate your beneficiaries, what you're essentially doing is you're listing a number of people that you would want that money to go to if you were to die. So for example, if you wanted to leave it to your brothers, to your mum, to your dad, cousin, auntie, uncle, whoever, you basically put their name down and you can list as many as you want. And you can also designate how much of what you have goes to each person. So for example, if you had three people, you could say, I want 50% to go to person one, person two to get 30%, then person three to get 20%. So you get to choose. So it doesn't die with you, but you need to be filling in your beneficiaries, your beneficiary form, and they ask you. And if they don't ask you, you need to ask them to say that you need to nominate beneficiaries for your pension, but it doesn't die with you. It can be passed on. And if it's passed on before the age of 75, so if you die before the age of 75, it gets passed on completely tax-free as well. That's a benefit within pensions that people don't often recognize. And it's a really, really powerful tool when we start getting around to conversations about inheritance tax planning. And that's one of the reasons why we always talk about pensions being so important, particularly if you amass quite a bit over your career and you want to leave something to your daughter, to your family, to your loved ones. A pension is a cheap and way cost effective way to actually do that, more so than things like your ISAs and your general investments and property, in fact. So people often dismiss pensions for no real good reason apart from maybe a little bit of misinformation. Pensions are a very interesting tool. All right, I'm going to take one more. I'm just going to find a good one. Bear me 1 second. Okay, let's have a look at this one from Lisa. I would like to invest, but don't know where to start from. Okay, so look, there's so much content out here, and I know what it's like. It's you can watch so many videos, read so many things, and it's just like wood through trees. Um, Couple of questions. What's your goal for investing? So, are you investing for what reason? Is it house, education fees, retirement, nest egg? What is it? What are you investing for? How long are you going to be investing for? So, is it 3 years, 5 years, 10 years, 15 years, 20 years? How long? Once you have the answer to those two questions, you should be able to get maybe a little bit of an understanding of where to begin. I do this stuff in coaching, so it's hard for me to kind of be like, right, do this, start here, without knowing a little bit more. But essentially, you need to know your goal. You need to understand how long you're going to be looking to invest for, your time horizon. You do need to understand what level of risk you're willing to take. So that will be dictated by how long you're looking to invest for. So I go through this on my investment course, essentially. We talk about time horizons. So if the longer you're looking to invest for, the more risk you can afford to take. If you're investing for a short period of time, i.e., maybe 3 years, then you should be taking as little risk as possible because you cannot afford for the market to crash and you need your money back whilst the market has crashed. So you need to understand that timeline versus the amount of risk that you're willing to take. Then you need to decide how you want to invest. So, do you want to buy individual stocks or do you want to invest in index funds, ETFs, that kind of thing? Once you decide that, the question you then need to ask yourself is, do you want to do it yourself? So do you want to go start picking those stocks on your own? Do you know how to do that? Do you have the know-how in terms of building a proper portfolio, picking those stocks, managing it, asset allocation, constant monitoring? Or do you just want to go and pick a few ETFs and index funds with someone, maybe Vanguard or someone like that, Fidelity, BlackRock? You have to pick them. So you have to know exactly what you're looking for and how you're going to structure this. Leave it, but know that your responsibility is to review it every single year at least. Or if you don't have time for any of that, would you rather go and put it with someone who would do all of it on your behalf? So, i.e., a money box, a money farm, a nutmeg, a plum. They will do all of that on your behalf. And all you basically then do is you set up a direct debit for 50 quid or 100 quid. They manage it. And that's their job, to manage it for you. Once you have the answer to those questions, you should be able to funnel down in terms of who you end up using and what you end up doing. That's a really kind of like high level, really quick fire point without me knowing much about you. If we were coaching, I'd be asking you so much more in terms of your goals and your circumstances, making sure you're ready. But hopefully that will give you kind of some context in terms of things to look out for. So I know that there's more here, by the way. I just can't get round to them all. We're an hour and 9 minutes in already. So, yeah, guys, look, we're almost at the end of the year. We've got 5 weeks left now towards the end of the year. I don't know about you, but it's been one of those ones where I'm knackered. I cannot wait to get out in December to be off for Christmas and New Year's. And I'm looking forward to some downtime and looking forward to maybe rejigging things a little bit in the new year on the channel. I've had a few thoughts and I've been thinking about things over the last maybe month or so about whether I can keep up the same level of content and how I might make the channel a little bit more interesting in the new year. I have a little bit more of an idea of how that's going to work closer towards, the back end of the year, maybe in 2 or 3 weeks' time or so. But yeah, I do appreciate you. By the way, we do have the short film landing on not tomorrow, which is Monday. It's going to be on my birthday, which is November the 22nd. So it's next Monday that's going to be landing. I have the second trailer to that arriving actually tomorrow. You know what? I should have just loaded this in here so you could have I could have given you a little preview to trailer 2 actually. I wonder, should I not? If I can load this in whilst speaking to you and it does it in time, I will give you a preview into the second one. But, the goal of this is to hopefully just give you a little bit of insight into my backstory and stuff like that. People have asked me so many times. So it's there on kind of like on camera. You'll be able to watch it and maybe just be able to digest it. The only thing I ask is, if you do enjoy it, please do share it. I spent quite a lot of money to produce it. I'm not going to recuperate any of that. It's probably cost about $2,500-3,000 to produce. I'm not going to get that back in AdSense, but if you're able to share it, that would be great. I just want to be able to have as many people see it as possible. The underlying message behind it all is supposed to be kind of, inspiring and uplifting. And I would love that to be received and seen by as many people. Obviously, it doesn't mean that everyone's going to take it in the way that it is intended, but that kind of stuff I can't really control, and I'm more than happy to kind of concede the fact that I can't control how people are going to receive it. But rest assured, it was shot and it has been delivered with the purest intent to hopefully be a little bit of an uplifting factor for people, rather than anything kind of like negative. And it's not supposed to be braggadocious in any way, shape, or form. But I'm waiting for this to load in. It's taken a little bit longer. But look, I've actually scheduled the second trailer to actually go live tomorrow at 12 noon. So I can't play it for you now, but I will just leave you with sort of the first trailer that you've probably already seen. But I appreciate you for spending the time with me this evening. Have an amazing week. I will see you on Tuesday. I do have a little bit of an interesting video to deliver on Tuesday, because I actually joined a pump and dump scheme to see what it is that they're doing inside their little scam engine. And to be honest, they've been pumping and dumping like coins for the last. I got a message on Instagram on Wednesday, and they've pumped and dumped, I think, about 4 coins at this point. And the amazing, I guess I say amazing, but the most alarming thing is, when I joined this group on Wednesday, there were 15,000, maybe 200 people in this group. Right now, there are about 18,000 people in this group. So 18,000 people actively taking instruction to pump coins. And unfortunately, it's not as transparent as you would see, because I've just been looking at it, dissecting what they're doing, and people are being taken for a ride. But I'll cover a little bit of that on Tuesday. But there it is, guys. Here's the... I never really got to kind of understand or know how the whole fostering came about. And I'd love to hear your side of the story.
Right, now then.
Me being sort of 7, I was excited. I'm going to get to go on the plane for the first time. That was exciting for me. I didn't know anything about it. And obviously, when I got over there, shock and horror. Oftentimes when you find yourself in that kind of situation, it's very easy to doubt yourself. And believe me, imposter syndrome starts to kick in, because it did for me.